In this video, I'll go through a comprehensive explanation of how to use the Fibonacci ratios for trading. The Fibonacci ratios are a very effective tool that could help you in quickly spotting market reversals. But like with most trading indicators, you shouldn't rely only on them to make trading decisions. In this video, we will first learn the concepts of Fibonacci before moving on to advanced trading methods utilizing the Fibonacci ratios. So let's get started with today's video. Before we begin, make sure to press that like button and subscribe to our channel so you don't miss any of our upcoming videos. We must first learn what Fibonacci ratios are. The Fibonacci number series is where the Fibonacci ratios come from. Leonardo Pisano, an Italian mathematician, developed the Fibonacci numbers. The series of numbers begin with 0 and continues by adding the sums of previous two numbers. For instance, if 0 plus 1 equals 1, then 1 plus 1 equals 2, then 1 plus 2 equals 3, then 2 plus 3 equals 5, and so on. The previous two Fibonacci numbers add up to any given Fibonacci number. These numbers are significant because they may be found across the universe in various contexts. Because ancient architecture, petals on flowers, and the structure of our faces and bodies are all related with Fibonacci, believers of Fibonacci argue that the value of any asset may likewise move in relation to Fibonacci. If you do the math, each given number in the Fibonacci series is 1.618 times the previous number. As a result, the number 1.618 is known as the golden ratio. Let us now look at how we might use the Fibonacci numbers in our trading. If you have been trading for a while, you've probably noticed that the price of any asset does not move in a straight line. The price is always moving in a zigzag pattern. Every time the price makes a significant rise, there is always a subsequent fall. As traders, we aim to capitalize on these massive impulsive swings. We attempt to take a long position towards the end of this retracement in order to capitalize on this massive up move. But the question is, how can we know when the downtrend is ended and the price is ready to rise? This is when the Fibonacci retracement tool becomes useful. When price is in an uptrend, it initially makes a large up move. Then we notice a small downward movement. This downward movement is simply a retracement. The Fibonacci retracement tool will assist us in identifying likely places of support for price during this drop. In a downtrend, the price makes a large down move followed by a pullback, which is this up move. The Fibonacci retracement tool will assist us in identifying probable levels of resistance where the pullback may finish and the price may resume its downward movement. Most charting platforms provide a plethora of levels under retracement tools. However, the majority of these levels are meaningless. Personally, I just apply the levels 38.2, 50, and 61.8. I recommend that you delete all of the other levels from your tool. To use the retracement tool, we must first properly draw the retracement tool. When the price is rising, we must first find the most recent significant swing low on the chart. On this chart, for example, this is the big swing low. Then we must find the significant swing high, which is this high point. We now select the retracement tool and draw it from the swing low's low to the swing high's high. The three lines in the middle indicate the Fibonacci retracement levels. They are between 38.2, 50, and 61.8% of the total rise in an upswing. At these levels, the price should find support. As can be seen, the price found support at the 61.8 level. For the bearish scenario, we will reverse the approach. First, we must locate the most recent swing high on this chart. The most recent swing high is shown here. Then, on the chart, we'll find the most recent swing low, which is this level. Now we draw the retracement tool from the swing high's high to the swing low's low. You'll begin at the swing high and finish at the swing low. The three lines represent the Fibonacci retracement levels. Because the price is now in a downtrend, we anticipate the Fibonacci levels to work as level of resistance. As you can see, the price forced resistance around 50% and instantly moved lower. A great tip to keep in mind here is that if the price is in a really strong trend, it will usually respect the 38.2% mark and will hardly move over it. This is due to the fact that in a strong directed market, trend pullbacks are shallow. When the trend begins to develop, the retracement will typically find support near 50 and 61.8% levels. In most trends, the price will tend to stay between 50 and 61.8. The 38.2 level will be considered only in a really strong trends. This was the theoretical aspect of Fibonacci trading. Let us now look at how to utilize the Fibonacci retracement tool to find and trade markets. First, let's go through the strategy's fundamental foundations. The first step is to identify the trend. Because this is the trend following strategy, we will first identify the trend and only trade in the direction of the trend. The next step is to find the most recent swing high and swing low. These are the swing high and swing low marks on the chart. We plot the Fibonacci retracement tool once we found the swing points. The retracement tool will show us price levels that will assist us in anticipating when the downtrend will finish. When the retracement approaches these price levels, we will wait for more confirmations before pulling the trigger and entering the trade. There are several methods which you can use to get confirmation. In this video, I will show you two confirmations that you may use with the Fibonacci tool. The first confirmation method is a simple moving average. If you've seen any of my previous videos, you know how much I love moving averages. They are simple yet effective indicators that can assist us in spotting high probability trades. As discussed in the past videos, the moving average functions as a dynamic level of support and resistance. It also assists us in finding the trend. Now, let's look at how we may use the Fibonacci retracement tool and the moving average. Take a look at this chart. The blue line is a simple 50-period moving average. Different moving averages may be used for different strategies, but for the purposes of this video, we will stay with the 50-period moving average. So, we can observe that the price has been trading mostly above the 50 moving average. The moving average has an upward angle as well. This indicates that the price is in an uptrend. Our aim today is to trade in the trend's direction. Therefore, we will only hunt for long setups here. We can now watch this upswing and identify the swing low and swing high of it. The Fibonacci retracement tool is then extended from the swing low to the swing high. Now, if the price falls, we expect it to find support at these three retracement areas. We don't know which level will give the price support at this time, but we do know that the price reversed from one of these levels. Another thing to keep in mind is that we already know that the moving average gives price support in an uptrend. Therefore, we can see on this chart that the 50% retracement level aligns with the 50 MA. As a result, there is a great likelihood that the price will find support near the 50% retracement level. There is a confluence of 50 moving average and the retracement level, which provides validation to our current bias. So we will attempt to enter a long trade when the price reaches the 50% level. Our stop loss should be placed at the 61.8 level, which is the level below our entry point. We can set our take profit target above the near-term high. As you can see, the price stabilized at our entry point for a few candles before reaching our target. Now let's analyze a sell trade. We can clearly notice on this chart that the price was trading below the 50% moving average. Because the moving average is also curved downward, we may assume that the price is in a downtrend. We will only look for selling opportunities now that the market is in a downtrend. If we look carefully, we can notice this rapid downward movement. As a result, we'll identify the swing high and swing low of the move and draw the Fibonacci retracement tool from the swing high to the swing low. When the price begins to pull back, we know that it will face resistance at one of these areas and begin another downward movement. But we cannot just execute a trade based on the retracement tool alone. We require further confirmation. As the pullback continues, we can observe that the 50 period moving average aligns with the 50% retracement level. Remember that the 50 period moving average also functions as a level of support and resistance as we discussed earlier. We anticipate the 50 MA to give resistance to the price because we are in a downtrend. So when the price reaches the 50% retracement level and the moving average, we anticipate sellers to step in and take the prices lower. The retracement tool and the moving average overlap at the same level, confirming the trade. So we can now enter a sell trade on this candle. We may set our stop loss above the 61.8 level and target the prior lows. And as you can see, the price fell sharply after we entered. Now let's discuss the second confirmation method, which is support and resistance. But before we do that, I would really appreciate if you like this video and subscribe to the channel. Now let's get into the second part. Support and resistance are a very straightforward parts of the technical analysis. A support level is a price level at which we expect buyers to step in and raise the price. A resistance, on the other hand, is a price level at which we expect sellers to step in and drop the price. It is vital to know that the support and resistance levels have a swapping characteristics, which means that if price breaks above a resistance level, that level will become support. Now, let's add confirmation to our trades by using traditional support and resistance levels. Take a look at this chart. We can tell that the price is in an uptrend because it's making large swings upward. Therefore, we are only going to look for long setups. We can see that the price made a significant rise here, then faced resistance around this price region 3 times. Therefore, we mark this price level as a resistance level. Finally, on the 4th attempt, the price breaks above the resistance level and sets a new high, converting the resistance level into support. Looking at this up move, we can draw the retracement by linking the swing low and the swing high. We notice that the 50% level is in confluence with the support level. Because there is a great confluence of retracement level and support, we may enter a buy trade when the price reaches the 50% retracement level. We can keep our stop loss below the 61.8 and our target at the most recent swing high. And as you can see, the price gave us a nice up movement after we entered. It is vital to realize that you do not need both confirmations to verify a setup. You can utilize either one confirmation. But getting both confirmations on the same setup makes it a high probability setup. On such setups, I tend to raise my position size and risk more than usual, knowing that the odds of failures are quite low. Take a look at this chart. We can see that the price made this up move, then encountered resistance and pulled back. Therefore, we labeled this level as a level of resistance. It then broke through the resistance level and continued to rise. When the price begins to retrace here, the retracement has now become a support. We identify this upward movement and use the Fibonacci retracement tool to draw the levels. The 50% level is in confluence with the support level as well as the 50 period moving average. As a result, we have 3 confirmations on this setup. The retracement level, moving average, and the support level all overlap in the same area. This means that the price will almost certainly bounce higher once it reaches this area. So we enter a long position as soon as price reaches 50% Fib level. We would keep our stop loss just below the moving average and aim for the most recent swing high. As you can see, price reached our target within the following candles. This leads us to the conclusion of this video. If you like this video, please like it and subscribe to our channel so you don't miss any of our future videos. Thank you for sticking around to the end of this video. Till next time, take care and peace out.